Today, I want to share with you my 2 never sell stocks. These are stocks that I cannot even imagine myself ever selling, that I will probably hold for the rest of my life, and they're the 2 stocks that I've owned for the longest in my portfolio. Now, every stock I buy with the intention of holding forever, but that doesn't always work out, right? Things change with the company, with the valuation, things change with my investment thesis, better opportunities pop up, but these are 2 companies where I can't picture myself ever selling and will probably own these for the rest of my life. So let's just dive right into the first one, which is Intuitive Surgical, ticker ISRG. Intuitive Surgical is a robotic-assisted surgery company. They help surgeons to perform laparoscopic surgeries with increased accuracy and safety. So originally, when they started out, they were used primarily for gynecology surgery, so things like hysterectomies, but they have expanded greatly, honestly, and they can also be used for heart surgeries, colorectal surgeries, head and neck, and one of their bigger divisions, which is just general surgery, which includes lots of different types of surgical procedures, specifically minimally invasive surgeries. And if there was ever a company out there that was a money tree, it would be Intuitive Surgical. So I put together this little PowerPoint slide because I'm a very visual person, and this kind of shows what I'm talking about when I call Intuitive a money tree. So you think of a tree and it has branches, and each of those branches has leaves. So if we think of those leaves as money, Intuitive Surgical is the tree. Each time they sell one of their robotic devices here, not only are they getting the branch, which is the device itself, but they're getting a whole bunch of little leaves in these attachments. So these attachments are consumable. They have to be replaced every time a surgery is performed. And they also tend to lock people into these $100,000 a year service contracts to service the machine and keep it well maintained, because obviously you don't want anything going wrong with your surgical robot machine. So that's what I mean by a money tree. Every time they install a new device, they get the money, which is $1 to $2 million per device. Plus, they also get $1,000 per surgery for these consumables, and they get $100,000 per year contract for servicing the device. So it truly is the prime definition of a razor and blade model. So you think about shaving, you buy a razor that typically isn't terribly expensive, but then you have to keep buying blades for that razor over and over and over, and that's how the companies make money. This is what Intuitive does. They sell you the razor, which, yeah, it's expensive, but I mean, for a big hospital, it probably makes a lot of sense. But where they really make their money is on the blades, which is the consumables and accessories. So this has led to 70% of their revenue being recurring and very strong gross margins. The problem is it's a very expensive stock. When I did my portfolio review video, I talked about Intuitive Surgical being the most expensive stock I owned, or one of the most expensive stocks I owned, and it's only gone up since then. So when I bought this company, I thought it was overvalued, and it has just always been overvalued. So if there's a company that you really like, that you think is a wonderful business, but you're worried about getting in because you think the valuation doesn't make sense, just remember it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. And also remember, you can always dollar cost average. So if you're on the sidelines, just maybe buy in a small position, and then if the stock goes up, great, you didn't miss out. If it goes down, great, you can buy more cheaply, right? It's kind of a win-win situation. So Intuitive Surgical, amazing razor and blade business model, very expensive, but I believe it's worth the price you pay. So Intuitive Surgical has pretty much everything I look for financially in a company. They have strong margins, they have great recurring revenue, they have great growth, they have an amazing balance sheet, they just check all of the boxes. They have diversified revenue, so we can see that instruments and accessories makes up 64% of their revenue, so that's recurring, and products make up 21%, and that's also recurring because those products eventually wear out and need to be replaced. Services is technically not recurring, but if they're locked into an annual contract, I have to believe that there's some aspect of customers coming back year after year. And like I said earlier, we can see that product revenue growth has been kind of steady, but instruments and accessories revenue growth is expanding. So they have expanding revenue growth because of that money tree. As more branches grow, the leaves that they get each year increase. So that's what I mean. This is a money tree company. This is just an insanely profitable business model. To show you what I mean, on revenues of $2 billion last quarter, they made net income, so that's profit of $565 million, so that's almost a 30% profit margin while growing 17% year over year. This is an amazing combination of growth and profitability that you don't often see. And like I said, they just have this beautiful balance sheet. And it kind of makes me wonder, why aren't they spending this cash? But then I realized they don't need to. They are a money tree. I'm going to stop with the money tree analogy. I'm sorry. But on their balance sheet, they have cash of $8 billion. They have $8 billion of cash just sitting there, and their total debt, every single piece of debt that they have, is only $2 billion. So they are in no trouble with their debt. They could pay it off if they wanted to. They're probably using it strategically. And they also have other assets outside of that just $8 billion. That is just their cash. Their total assets is $17 billion. So this is just a fortress balance sheet. Okay, I'm going to stop nerding out about balance sheets now. One other thing that I really like about Intuitive Surgical is that even though they are quite profitable today, they have a lot of growth opportunities as robot-assisted surgeries continue to grow in popularity. People become more and more comfortable with them, especially after seeing the statistics that they are much safer, and they're worth the money for a hospital to implement. So we can see 22% procedure growth for 2023. Now remember, as procedures grow, that doesn't directly tie into the company's growth because they just sell the machines, not the procedures themselves. But keep in mind that those consumables can only be used once, usually per procedure. So every time a procedure happens, people have to buy more of those quote unquote blades, and you get the picture. This is just a compounding machine. So that's Intuitive Surgical, my number one never sell stock. I've owned it for quite a long time. I've done quite well on it. And even though it's overvalued, I'm happy to keep holding this amazing company. All right, the next one that I want to talk about, my never sell stock, is a little company called Clean Harbors. And this is a company that most people probably haven't heard of. It's a US-based company. It's a smaller, maybe mid-cap company, and their business is not very exciting. What they do is mostly environmental services, but if you know anything about me, if you've been on the channel for a while, you know that I love sustainable investments, that I think that's going to be one of the biggest investing themes going forward is sustainability, and I also like when companies can be sustainable and make money while doing it. So once again, I put together a little PowerPoint slide to show what Clean Harbors does. Their two main business segments where they have leadership positions in is oil recycling. They are the number one oil recycler in the US, and waste incineration, which is literally just burning garbage. And they are number one in the US at that too. Like I said, not exciting, but a necessary business nonetheless. Some other branches of their business are hazardous waste management, so disposal and processing of hazardous waste, and emergency spill cleanup. So if an oil truck tips over, spills oil all over into the earth, that's really bad for the environment. We have laws against that. Clean Harbors will come out and clean it up. That's where their name comes from. Same thing with our oceans. Same thing with any type of toxic hazardous waste that gets spilled. Clean Harbors can probably help remedy that. Like I said, they're sustainable. They avoided more than 3.5 million metric tons of greenhouse gases last year, and they responded to 14,000 emergency events where hazardous materials were released into the environment. So this is a company that I believe has a bit of a moat, and let me tell you why. I found this neat article from, I think, just an individual retail investor who seems to have a website about value investing. It's a pretty cool website. I can link to it in the description, but he was talking about how Clean Harbors has developed a moat in hazardous waste. And I think it makes a lot of sense. He talks about the Resource Conservation and Recovery Act, which is an act that was passed in the United States, and it sets standards for the treatment, storage, and disposal of hazardous waste. So, even though this doesn't seem like a very profitable endeavor, there are a lot of regulations around it. And when there's a lot of regulations around something, that means that there's going to be higher and higher barriers to entry. So sure, you could say that this is kind of an artificial moat because it's been imposed by the government. However, environmental laws like this, once they're enacted, tend to stay in place for a very long time, indefinitely, I would say. So it's going to be very hard for other companies to compete with Clean Harbors. And also, this is such a niche that there are not that many companies that will want to compete with Clean Harbors. It's not a desirable place to be. It's kind of capital intensive. It's kind of hard to scale. And Clean Harbors has already done that. They've scaled successfully with a little bit of luck and a little bit of determination. They have become this $13 billion company that they are today, with not a ton of competition. Like I said, number one in the US for oil recycling, number one in the US for incineration of garbage. The other thing that I think is really cool about this company is it's a very down-to-earth company. Clean Harbors started with 1 truck and 4 employees. I just think that's so cool that they were able to scale to, like I said, a $13 billion company today. I also think that Clean Harbors can come to the rescue with some of the recent natural disasters that we've been seeing in the United States. Anytime there's an emergency, even cleanup and removal of a single mercury bottle or a large-scale multi-phase containment and cleanup of a coastal oil spill or damage from a hurricane, right? We know that those have been going on a lot in Florida in the US lately. Clean Harbors tends to be contracted by government organizations as well as private businesses to come and help. So I don't want to make light of the recent disasters because the hurricanes, especially in Florida, have been quite bad, one after another. People's homes have been devastated. They've had to evacuate. But it's really cool to see that this is a company that can come to the rescue in those tough times. Clean Harbors also has that really nice combination of growth and value that I look for. I consider myself a blend or core investor. So there's kind of three investing styles: value, growth, and blend. So value focuses on companies that are generating profits now and tend to not have a lot of growth. Growth is the opposite. They tend to have a lot of growth and not as much profits. Blend is a bit of both. They might have some steady growth and some steady profits. Those are the companies that I tend to like personally. And Clean Harbors really fits the bill. Their revenue grew 12% year over year. Some of that was inorganic, right? They do make acquisitions, but some of that was organic revenue growth. Like I said, environmental services experienced healthy demand, and their field services, which you would think would be really difficult to scale, has continued growing and growing. They're also building out their infrastructure in order to continue to grow. So like I said, they are the leader in waste incineration, and they are building this Kimball incinerator, which should launch this year and actually next month. So as you can see from this picture, it takes a lot to build out an incinerator. You would think it's just a little fireplace where they toss trash in, but there's really a lot more to it. You can't just throw anything in there. There are environmental impacts and health impacts to think about. Anyway, these investments in infrastructure should continue to fuel future growth for Clean Harbors. And since I praised Intuitive Surgical's balance sheet, I think I have to be fair and talk about Clean Harbors' balance sheet, because it's not great, it's not bad, but this is the only thing that maybe I don't like about the company. They have about $500 million in cash, which is nice for such a small company. However, they do have a lot of debt. Like I said, this is a capital-intensive business. They have to buy trucks, they have to buy equipment, they have to buy, facilities. All these things are expensive. So we can see they have property, plant, and equipment valued at $2 billion, and they have long-term debt of about $3 billion. So we know that most of that long-term debt is probably for their infrastructure, right? However, if we look at their current ratio, so this shows short-term liabilities, so things coming due or things turning into cash within less than a year, right? Current assets can be turned into cash in a year. Current liabilities come due in less than a year. If we look at their current ratio, they have current assets of $2.4 billion, current liabilities of $1.1 billion. So they have more than double their current liabilities in current assets. So even though the balance sheet isn't the strongest, it definitely is strong enough to cover their short-term liabilities. And they do generate free cash flows, so when those long-term debts come due, they have options. So that's Clean Harbors, a company that has established a little moat in a very interesting niche. It helps the environment while making investors money, and they've been seeing some increased demand. Intuitive Surgical, the money tree, the company that the more devices they sell, the more quote-unquote blades they can sell, the more money they make, the more they continue to grow. It's just a fantastic business, and it's also safer for the people getting these surgeries. So again, a win-win. So these are my two never sell stocks. Let me know what you think of them. And what are you guys' never sell stocks? If you had some stocks that you can never picture yourself selling, let me know in the comments below. I'd love to read and see what you guys have to say about that. And if you missed the little skits at the beginning of my video, I've been doing the skits with the little floating letter A and myself, or Johnny, I should say. It's not me, it's Johnny. Those will be coming back. I just didn't do any this week. I didn't feel like this one merited a skit. So if there's ever a video where I think a skit can fit in, I think I'll do those. People seem to like a little bit of humor at the beginning of the videos. But anyway, thank you guys so much for watching. Please like the video if you liked it. Please dislike the video and leave me some constructive feedback if you disliked it. Thanks so much and have an amazing day.